Greetings of the day to the beautiful person watching this video. I am Arpit Sanjar, whom you are going to bear for the next few minutes, speaking on the topic Budget Analysis 2020 with reference to the two regimes given as an option to the taxpayers of our nation. Be careful what you wish for, there's always a catch. These words by Laurie Hals Anderson aptly apply to Indian taxpayers today. The budget 2020 saw the Finance Minister, Mrs. Nirmala Sitharaman, announce a new tax regime with more tax slabs and lower tax rates. This was long demanded by most taxpayers, but it came with a catch of removal of all the deductions and exemptions available. To add to this confusion, the finance minister gave taxpayers a choice between this new regime and the existing one, leaving it to them to decide which they would opt for. All these factors acting together, instead of tax laws getting simpler, are now more complex. Now, if you are wondering how to go about figuring out which regime you should opt for, this video will answer your question. We will look at the new regime in detail, its benefits, and compare it to the existing tax system. The current tax system is complicated, to say the least. While the tax rates are high, there are a lot of ways to reduce your tax liability. Over the years, the government, through addition of clauses to the Income Tax Act, have given Indian taxpayers over 70 exemptions and deductions options through which they can bring down their taxable income and hence pay less. While exemptions are part of your salary like house rent allowance and leave travel allowance, deductions allow you to lower your tax amount by investing, saving, or spending on specific items. The biggest section for deduction is section 80C, through which you can bring down your taxable income by rupees 1.5 lakh. Apart from this, there are several other sections that let you take tax deduction on things ranging from interest on your loans to premiums you pay for health insurance. The combination of exemptions and deductions can bring down your taxable income back lakhs. However, it also means every year you have to find out ways to optimize your salary and savings or investments so as to keep taxable income to the minimum. The new tax regime is different from the existing system in two aspects. One, the tax slabs have increased accompanied by lowering of rates in the sub 15 lakh region. The second, all the exemptions and deductions that were being used by taxpayers in the existing won't be available in the new regime. Under the new system, income between 5 lakh and 7.5 lakh would be taxed at 10%, while income between 7.5 lakh to 10 lakh would be taxed at 15%. This was 20% flat on the entire range for the existing regime. The earlier 10 lakh plus slab where you paid 30% has been broken into three parts with the rates of 20% for 10 to 12.5 lakh, 25% for 12.5 to 15 lakh, and then 30% for 15 lakh and above. Unfortunately, there is no single answer for this, and the culprit again is the complexity of Indian tax rules. Although, looking at the tax reduction in the tax rates, the first reaction would be that the new system looks better. However, with these cuts, someone with 7.5 lakh income will have to pay rupees 25,000, and for those who are earning 10 lakh income, the tax saving will be 37,500. But as they say, the devil lies in the detail. For these savings, you will have to let go all the exemptions and deductions which might nullify these gains. While figuring out what option to go for might look complicated, if you approach it in a systematic way, it is not that difficult to figure out. Here is what you need to do. Calculate all the exemptions that you are availing and look at the deductions that you claim. Now combine these exemptions and deductions and minus from your salary to see what is your taxable income coming to and what it would be if you let go of these deductions. This should be the deciding factor for which regime you should go for. Let's take an example to see how deduction and exemptions or lack of them will impact taxes in both regimes. Let's take example of my brother Anurag, who is an IT professional in Pune. He earns rupees 13 lakh a year. Being salaried, he contributes towards the EPF, reducing the standard deduction of rupees 50,000 here and the deduction with respect to section 80C, that is rupees 75,000. I'll make another video to explain this section and the related sections in detail in my next project. Coming back, Anurag is also eligible to claim tax exemption for rupees 30,000 in house rent allowance, rupees 20,000 in leave travel allowance, and rupees 26,400 for Sodexo meal coupons respectively in his taxable income. So after all this, his net taxable income in the old regime becomes rupees 10,98,600 and remains rupees 13 lakh in the new regime. Now let's see how his tax liability changes in either of tax structures. You must know that a person has to pay tax for every additional 2,50,000 he earns till rupees 15 lakh, above which on the remaining amount he has to pay a tax of 30% of that amount in either of the regime. The new regime has comparatively lower tax rates to the old one for the rest. Apparently, Anurag can save rupees 4,580 and enjoy all the exemptions and deductions if he stays in the old one. It would be expensive for him if he had gone for the less tax rates. Reiterating the fact that in Union Budget 2020, Finance Minister has acceded to the demand, but with a caveat. To take the simplified tax structure, you will have to let go of a host of exemptions and deductions offered so far. The current income tax regime and the new one will exist simultaneously with the option of choosing between the two. You, the taxpayer, will now have to decide which one works for you. Ironically, as seen, the simpler tax regime comes with embedded complications, triggering confusions rather than a sense of relief. Plan ahead to take an informed call. There is no single answer to the switch or stick question, and it does not just depend on your income or salary structure. You also need to look at your investment habits, your age, life stage, goals, responsibilities, and likely expenses. You will have to plot your actual income and deduction figures to decide whether to switch or not. For example, if you are a young individual and dislike paperwork and claim little or no tax saver benefits, the new regime might sound inviting. Foregoing these tax benefits to ensure more money in your hands will not be a difficult choice to make. However, for those who do take multiple tax breaks, the older regime will help save more on taxes. Therefore, financial planning is now more critical than ever. Old is gold for most. Financial advisors are unanimous in their opinion. The older regime is better for most if you have been availing of multiple tax benefits, mainly those that give you an impetus to invest, such as Section 80C and 80CCD tax benefits. As said by Mr. Pankaj, in most cases, the old regime will turn out to be beneficial. Only those who did not make an effort to invest in Section 80C's avenues and avail of other deductions or could not utilize this 1.5 lakh limit due to higher expense could find their tax outgo going down in the new regime. Also, as seen in the previous example of my brother, old is gold for him. However, most individuals also utilize other benefits apart from the Section 80C. Putting it simply, the higher the number of deductions and exemptions, the better is to stick to the old regime. Do not ignore long term savings. For millennials or those in the first or second job and claiming minimal tax benefits on account of relatively lower PF deduction, the prospects of moving to the new regime might seem interesting. After all, it will be easy to let go of lower eligible deductions as also avoid of the pressure of investing more to claim higher tax breaks. They could be left with more money in their hands beside bidding goodbye to paperwork. But that doesn't mean it's okay for the young one to not to save. The urge to splurge this additional disposable income could mean indiscriminating spending, especially through credit cards. Not only it can lead them to a debt trap, but lack of savings can also hamper their financial futures. On the positive side, however, foregoing Section 80C will eliminate the possibility of any taxpayer falling prey to insurance agents' sales pitch for low yielding endowment policies. Disciplined investors can always look at equities for long term goals. NPS gets the edge now. The new tax regime does get one tax benefit though. That's the National Pension System. In her budget speech, Finance Minister said that nearly 70 exemptions and deductions will be removed from the new tax regime, out of over 100. There are some tax benefits that escaped the axe, Employer's contribution to the NPS that is deductible from your salary under section 80CC D2 is one such tax break. This deduction limit is 10% of your basic salary plus D&S allowance. Whether you choose the old regime or the new one, ensure that you inquire whether your employer offers this option and take the same. Choose a charity with care. One of the deductions you can presently claim is on donations made to charitable institutions. Based on the organization, you can claim 50 or 100% of the amount donated under Section 80G. The pain point for taxpayers has been in claiming the deduction, as donors had to preserve the receipt after the financial year. This was because he or she had to quote the details such as the receipt number, charitable institution's address, PAN, and the amount donated in the tax return form. Budget 2020 has eased this process a bit. Now the income tax department will directly get your donation details from the charitable organizations and mention the details beforehand in your income tax form. In simple words, your income tax form will come pre-filled with your donation activities. An essential condition here is that the charitable institution needs to be registered with the IT department and should have obtained a unique registration number. If you make a donation, ensure that your charitable trust has completed this process. In light of the above and considering the new personal tax regime wherein certain deductions and exemptions would not be applicable in case of taxpayers opting for concessional new tax regime, the taxpayers may evaluate both the regimes. Any taxpayer who is looking for flexibility in the investment choices and does not want to invest in the specified eligible instruments may consider opting for the new tax regime. However, it is advisable to do a comparative evaluation under the both regimes before opting to continue with the old regime or opting for the new regime. It is notable that the choice can be exercised every year and any regime which is beneficial can be adopted by the individual. Individuals who have income from business or profession cannot switch between the new and old regimes every year, however. If they opt for the new taxation regime, such individuals get only one chance in their lifetime to go back to the old regime. Further, once switched back to the existing tax regime, they will not be able to opt for new tax regime unless their business income ceases to exist. So, my beloved taxpayers, choose wisely. I am Arpit Sanjar and I am grateful to you for listening to me. Thank you.